Recent rally on Wall Street losing steam in December. This comes as investors eye incoming economic data this week, looking for signs of what the Fed's future path may look like for monetary policy. Here to discuss is Abbas, Oakmark Funds portfolio manager and co-head of fixed income at Harris Associates. Thank you for joining us here today. Been talking a lot about what the Fed is expecting to do. Got that JOLTS number earlier. We've seen the labor market headline figures look good, but the internals looking a little bit soft. What's your take on the macro forces here at play?
Well, I think, you have to be balanced on your approach on thinking about this. I think what the Fed is trying to say, it's not an uber dovish message. We had a big movement in rates over the last 3 to 4 weeks, but the interpretation might have been a little too dovish. I think what the Fed is really trying to say is that we need to think about now both the risks to inflation, still managing those risks, but also now, more importantly, starting to weigh more balance to the economy and the risks to the economy in 2024. Like you said, JOLTS data, you're starting to finally see some loosening in the labor market. You're starting to see some leading indicators pointing to a slowing economy. And I think we need to think about 2024 where the Fed probably remains in this higher restrictive range, but there are growing risks to the economy slowing.
Speaking of risks, it seems like we're getting this growing course that the market is getting it wrong when it comes to the timing of not just the first rate cuts, but sort of then the rhythm of the rate cuts.
Sure.
Is that the case? Is the market getting it wrong?
We think so, and it's not the first time. And I remember coming into the year, there was a very aggressive cut forecast as well coming into 2023. Now we think maybe, again, post this more balanced messaging, it was a pivot, but it wasn't really dovish. I think it was a misinterpretation that the market is now saying we're going to cut all the way up into March, and we're going to cut 4 times, and we're going to exit the year 100 basis points lower. We think that's too aggressive. I think if you show up late to a party, you generally want to stay a little later to the party to help clean up and make sure the messes are cleaned up. I think Powell is going to look at this the same way. He showed up late to the inflation party. He's going to make sure to stick around extra time. The mess is cleaned up. Volcker, he's a student of history. Volcker went through this in the early 80s. He cut a little too quickly, and he had to deal with the ramifications of a reflation, that episode that happened in early 80. And so I think Powell's a student of history. I think he's going to be more careful. I think the market's too aggressive. I think we're really looking at Harris a back half of the year starting to cut, and then be very patient with those cuts. Now,
it seems as though Powell has been fairly clear and in line with what you're saying. Why isn't the market, this, and again, this is not the first time that he has said one thing and the market has heard something different. Yeah. What do you think is going on?
It's a great question. In the near term, I think some of this could be technicals. We saw, the previous month, we saw a lot of positioning go short bonds, selling out of bonds. There was a narrative really coalescing around a lack of fiscal discipline, the fiscal hawks coming back out. There was this tail risk building that yields would go a lot higher. When I say a lot higher, we were talking 6, 7, 8% not too long ago. I think we had 2 good inflation prints. We've seen some G7 economies have good inflation prints as well. And then on top of that, we've seen some economic data slow a little bit. So I think it reversed a lot of that pessimism to the upside on yields. And maybe that's why we saw a big reaction to the positive side.
Let's keep talking about bonds here. This was going to be potentially the 3rd year of losses in bonds, something that's happened maybe once or twice in the history of the United States here. And let's go to the Wi-Fi Interactive. Just want to show a quick chart here. This is the 10-year T-note yield trending up over the last 3 years. Guess what bonds have been doing? They have been trending down. That's TLT. Are they going to bounce back? Are they going to become a bigger part of people's portfolios? And I think more importantly, are we going to return to 60-40, or are we in a new era where we got to figure out some other portfolio balance?
Yeah, I think despite the large move lower in both yields and spreads over the last 4 to 5 weeks, we still find fixed income, especially fixed income active management, an attractive place to be. Real yields are still above 1.5%. We lived in the QE era, we lived post-GFC, we lived in a negative real rate world for a long time in fixed income. Today, we're above 1.5. We think there's good all-in yield carry for most fixed income asset classes. And if you're willing to look under the surface, below the benchmark spreads, there is a lot of dispersion that's occurring. So we think if you're willing to go and do the work on cash flow statements, balance sheets, work with management teams, understand capital allocation, that there is a lot of value, both carry, high carry, and total return under the surface, and that's where we make our bread and butter at Harris and at the Oakmark funds.
Do you think that investors are going to be slow to, I mean, and you guys are dealing more on the institutional side, but certainly we have seen retail investors, pour money into things like CDs,
Sure.
right? Do you think that money is going to be sort of slow to come back into more complexity and
More duration,
right? Exactly.
Yeah, I think so. They had retail investors and all investors, quite frankly, had a pretty good run owning the front end, money markets, CDs, 1 year T-bills, and collecting a high carry and without a lot of a reinvestment risk. In fact, protecting capital fairly well. I do think it's time to change that stance. I think it's time to educate the average retail investor that now is the time to be extending out the curve in duration, how that will actually help protect capital, and how there's actually much better attractive all-in yield and carry than there was over the last decade. And so yes, I think 60-40 is back. I think it's going to take a lot of education, and it's going to take the retail community, quite frankly, warming up. A lot of them were burned, weren't used to mark-to-market losses, certainly to the extent in the mid-teens range like we saw over the last couple of years.
Yeah.
The last 3 years have burned so many people on so many different fronts. We have to leave it there, but really appreciate you stopping by here.